Okay, welcome everybody. Thank you for joining our Stenger Family Office Honeywell Fidelity 401k rebalancing during volatility. My name is Nick Stenger. I'm the CEO and a financial advisor with our firm. We've been around since 1981, and Honeywell has been one of our favorite companies to work with. And so many of your peers are clients of ours, and it's been just a real honor to work with many of you. And I see some of you on today are clients, so thank you for joining us. And we hope you enjoy today's presentation. We will try and get you out of here within a half hour so you can get back to your day. But we will just go through a few items before we jump into content about the 401k. We do have other webinars that talk specifically about financial planning and other items as well. But today we'll really just talk primarily about the 401k in general. And I want to make sure that you can see my screen. So we are going to roll through this first slide here about Stenger Family Office, and I hope you can see this. If you can't, throw it in the chat. Let me know if you can see it or not. But again, we are a fiduciary, fee-based, independent wealth management firm. And simply all that means is that we are independent of a bank. We're not incentivized to sell product. We don't have any mutual funds that are proprietary to Stenger Family Office. We're not incentivized by commissions. In fact, we don't even have sales or commission licenses. All we have are our fiduciary licenses regulated by the SEC, which makes us independent. And so as a registered investment advisory firm, we are required by law to operate in your best interest. So be careful when you hire a financial advisor. They should not have a Series 7. That's the license that you would look for. You want them to have a Series 66 license, which is the fiduciary independent license. That's what you're looking for. So I'd encourage you, whether it's our firm or any other, look for a registered investment advisor, somebody who can put your interests first. We are also a family office. You saw in our name, Stenger Family Office, that we have capabilities beyond just investment management, portfolio management, and financial planning, which we do very well. But we also have in-house tax preparation, tax strategy. We have estate planning. So we literally have attorneys right here in our office with us. We have CPAs that can do your tax return, and we bundle it into a package. When you get over the $2 million zone, we actually include a lot of that cost. But clients of any size, and this gets into the last point, next generation support, that we will help you at any point in your journey. So whether you have $1,000, $10,000, wherever you are, millions of dollars, we can help you. We have a process for it. And if you are a client of ours, we want to help your next generation. We want to help the kids and grandkids. And one of the things that I'm most proud of with our firm is because we've been around for so long, it's since 1981 now, we have worked with 4 generations from the same family. We have multiple 4-generation families, and that is just really special. That's neat. We want to do that with you and your family, hopefully, too. We are licensed in all 50 states, and today we're going to talk a little bit about the Honeywell 401k process, but we do have our Honeywell retirement process that we go over in depth. If you're interested in that, let us know. And then the other thing I'll tell you is get a starter account going before you retire. I would encourage you to do that. Don't wait till you're 2 years out or 1 year out. Get an account going now, and it literally only takes $1,000. So at $1,000, we charge $10 a year. It gives you at least an intro to our team. We give you a financial plan as part of that for no additional cost. And then the other thing we do is within our financial planning software, we actually link up your Fidelity 401k, and we will start to advise you on that as well, and we don't charge for it. So just get a starter account going. It doesn't take much, $1,000 minimum, and we will help you out with the rest of the plan before you retire. If you have net unrealized appreciation, some of you do, we can help with that. If you have stock options, we are very good with stock options as well. And then if you do, now Honeywell is a little disjointed from the standpoint that there are many different companies under the Honeywell umbrella now. Some of you have pension plans, and we can help you analyze that. And that's where it can add a little bit more complexity to your taxes and the rest of the plan. So because of all of this, I would, again, schedule a one-on-one meeting with an advisor, whether it's myself or another advisor on our team, and do the starter account. Encourage you to think about that, and then we can get you going on that advice on your 401k before you retire. Now, one of the things that I think is very helpful before we jump in, this is the last thing, is get our 2023 Honeywell guidebook. If you'd like the guidebook, there's a chat box in front of you. Throw it in the chat that you'd like a guidebook. We will get it out to you. One of the neat things about this is there's a page that we have done for our families in the oil and gas sector. I know Honeywell is not only oil and gas, but we have done a benchmarking survey, and it'll show you based on where you're at, how old you are, how long you've been at the company, what you should be at, relatively speaking, from a asset and a savings standpoint. And again, this is not financial advice, but I would use it as a benchmarking tool. Throw that in the chat if you want to receive that guidebook. We'll send it out to you. Let's talk a little bit now about the 401k and some of the big ideas behind it. Number one, it's a defined contribution plan. This is different from your grandfather and great-grandfather's generation that had a defined benefit only. And companies have shifted the risk from the employer, which they would have had with the pension plan, to today to the employee, which you have with the 401k. And so you have to take control of your own financial future. Nobody's going to do it for you. That's the reality of the 401k. And so it's not a set it and forget it, or at least it shouldn't be. And we take it very seriously because your 401k will ultimately be one of the biggest assets you have. You want to take it seriously. You've got to get, in my opinion, you have to have somebody professional look at it on an annual basis to make sure that you're not leaving anything on the table and making sure that your investments are allocated properly. So 401k, it's your responsibility, but I would tell you, get somebody who can at least look at it for you. We don't charge for that. That's part of our starter account package, and give you some advice. You can do pre-tax and after-tax contributions. You do get a company match in most cases. There's a few subsidiaries of Honeywell that don't do a match, but most do. And then we'll talk a little bit about the investment options and how to rebalance during this volatile period. So here's some of the tax benefits. The nice thing with the 401k, and this is almost any 401k out there, is that you can contribute a pretty substantial amount of your salary. You can go from 1 to 20% in most cases at Honeywell. Honeywell is a little unique for us because from other companies we work with, only because there are so many subsidiaries. So we want to just double check this depending on where you originally came from. But the bottom line is for everybody who's with the Honeywell 401k at Fidelity, you will have a max for 2023 of $22,500 that you can contribute on your end to the plan. And that does not include what Honeywell matches. And then, of course, if you're over the age of 50 or higher, you get a catch-up contribution, which increases your total contribution amount by $7,500 per year. If you make your contributions on a pre-tax basis, you actually reduce your taxable income dollar for dollar for the amount that you put in. And we'll talk a little bit more about what that means exactly on the next page. But the best part about a 401k is the fact that you get a tax benefit now, you get a deferred tax benefit, and sometimes you even get a tax benefit later on. And so if you're not maxing out, you really should be. And we'll talk about that on a financial planning basis if you book a meeting one-on-one. If you have some debt that you need to pay off, that's one exception. We may have you pay some debt off first. But if you are relatively debt-free outside of your mortgage and maybe a couple cars and things like that, then we want to max that 401k out as best as we can so that you aren't leaving money on the table. And then Honeywell, of course, is going to match the first 8%. Now, this is for most Honeywell people, but again, there's some subsidiaries that don't do this. First 8% of your pay at a rate of 87.5%. And so if you multiply these numbers together, you've got basically a match up until the 7% of your base salary. This is widely true across the board, but I would say look at it on an individual basis because it may be a little bit different depending on where you came from. Your match is going to be based on a max annual income of $330,000. This is not a Honeywell amount. This is an IRS limit. So if you're making $330,000 or more, you're going to be capped at that amount. They're not going to match you past that. So that is how the 401ks work. Remember, Honeywell's contributions are never going to be a direct tax write-off against your taxes, but the way that it works is those contributions grow tax deferred. So it's still a really nice feature. Bottom line, you should be maxing out and at least be getting the match from Honeywell. So here's a good way to decide if you are pre-tax, or if you should be doing pre-tax or Roth contributions. The easiest way to understand this is pre-tax contributions give you a current tax benefit right now, right this second. So if you make $100,000, for example, and you put $20,000 pre-tax into your 401k, the IRS says you only made $80,000 on a federal tax basis. That is a massive tax benefit. There's not a whole lot of other benefits out there like that. So you get the benefit right here, right now. The Roth contribution does not give you that immediate benefit right this second. It gives you a future tax benefit for when you're retired, because one of the things that's coming down the road, no matter how old you are right now, usually by the age 75, for 90% of people on this call today, the age will be 75. You will have to take a required minimum distribution off of your IRAs. And so that's one of the reasons why people like doing a Roth, because there aren't those same required rules. Here's two approaches, and we can talk about this individual on a one-on-one basis later on. But you can do a balanced approach. I see a lot of people do this. This is something we recommend from time to time, where you do 50% pre-tax and then you do 50% Roth. That's an easy way to kind of hedge yourself on tax rates, especially if you don't have a whole lot of other after tax. You don't have a brokerage account, for example. You don't have an account at Schwab or Vanguard or something like that yet that you're contributing on an after-tax basis. So if your 401k is your main asset, a lot of times a 50-50 approach can be a good way to go. So we'll talk about that on a one-on-one basis more and looking at your tax situation, but that's one idea. And then the second idea is you do this crossover zone analysis. You look at it's called MAGI, Modified Adjusted Gross Income. And depending on those numbers, if you're making about $228,000 as a married couple filing jointly on your return, sometimes it's better just to go ahead and go 100% pre-tax. And then obviously we have the number on there for if you're filing single. So we can, again, help you with this on a one-on-one basis, but these are just some really basic ways to think about it. Here's your investment options, and this is where we'll spend the rest of our time today, is how do you allocate, given the fact that the 401k is your responsibility. You don't have a pension fund manager who's going to do this for you. You have to make the decision. And then you also have to stay invested over time. Here's the options we have. Now, Honeywell, we work with five companies, five major Fortune 500 companies is where we spend most of our time. Honeywell is actually a pretty decent plan. It's not the best, it's not the most options we've ever seen, but it's definitely not the worst. You've got some good choices. Let me go back one slide here. The options here in the blue are typically going to be your best bet, and we'll talk about how to allocate there. We typically keep you away from the purple, and then we try to be very careful with the fixed income, and we really want to stay away from the darker green, the target dates, and we'll get into why that is. So let's jump into the S&P 500 for a couple of seconds here. It's the S&P 500. It's the 500 largest stocks in the United States. So these are all U.S.-based domiciled companies, and these are going to be all your household names. Honeywell would be included in this. Honeywell is not in the top 10, but it is in the S&P. And so you've got Apple, Microsoft, Amazon, NVIDIA, Google, Facebook, Berkshire Hathaway, Tesla, United Health Group, and ExxonMobil. Those are the current top 10 holdings. The return numbers on the S&P have been absolutely fantastic. If you look at the 1-year return, you look at the 5-year, of course, the 10-year. And the reason for that is technology has really dominated our economy and the marketplace for a long time now. I am a big fan of you taking a substantial amount of your 401k and benchmarking to the S&P. And it's not perfect. There's a lot of companies in the S&P that aren't profitable and that we wouldn't want to own once you're retired. But for now, this is about as good as it gets as long as you're in the 401k. So I would have a substantial amount tied to the S&P. As you get older and closer to retirement, we may change that a little bit. But for most of you on today's call, this is going to be a fantastic place for you to have a bulk of your portfolio. Let's talk about the small and mid cap option that Honeywell gives you. And this is going to be companies that you may not have heard of, maybe you have, but they're going to be smaller companies, mid-size, that are have some growth potential. I would be a little more cautious here, at least in the next couple years. And for our clients that are already with us, when we do our portfolio management rebalancing process and we actually change their investments that we manage for them, we have stayed away from small cap stocks and we have stayed away from mid cap stocks for the reason that small and mid caps really face an uphill battle with regulation, and they also face an uphill battle when it comes to financing. A lot of these companies got loans back during COVID in the 2020, 2021, when rates were near 0%. And so I've got a lot of management folks, management type people at companies like this who tell me, Nick, it's going to get a little tough here for small and mid cap companies for the reason that they are overly exposed to the higher interest rates, and so a big company like Apple can just go right into its balance sheet. It's got a ton of cash on hand. Some of these smaller and mid cap stocks just can't do that, and so they're number one, either facing 10%, 12% interest rates the next couple of years, or just no financing at all. And I think that could weigh heavily on that income. And you've already seen this in the stock prices. Look at the 5-year return now on small and mid caps in the 8% zone, substantially less than the 12% number on the large cap. And I think that's a trend that could continue. So if you're younger, if you're kind of under 50 or under 45, even somewhere in there, we could have some exposure, but I wouldn't overdo it. I'd just be a little bit cautious. International stocks have been a complete debacle the past, you can see 10 years now. And if you just go down to the bottom of the screen and look at returns, the 10-year returns on China, Europe, Japan have just been an absolute nightmare for investors. As for our clients, we have not owned international stocks again for 5-6 years now. And the reason why is even if you find the best company abroad, even if you find the best stock in Europe or you find the best stock in China or whatever it might be, you still got to get that money back to the U.S. You still have currency hedging that you cannot do in the 401k, and that kills the return over time. I have never seen, in our experience, it's very hard for people to make money long-term in these markets, with one exception, and that's India. But unfortunately, with your 401k, you don't have direct exposure just to India. So I would be cautious. I would be very careful on how much international you own. I would be very cautious how much emerging markets you own. I would like to keep you in U.S. stocks. I think China's got an uphill battle. I think if you throw your top billionaires into prison anytime they speak out against the regime, you're not going to get a whole lot of long run innovation. And so the China return the past 5 years has been negative. China has produced a negative return for 5 years. Taiwan is a decent place to invest. South Korea is a decent place to invest, but I'd rather do it directly. We cannot do that in the 401k. We're overly exposed to China. We're overly exposed to places that really don't make a whole lot of long-term sense. And then Japan's got its own issues with negative population growth and a massive debt load, and Europe faces a lot of the same issues. So some things to think about here. Let's talk about bonds. I would be very, very, very careful with the bond market in general. And so when you set out as an investor, you have one of two choices. You can either be a lender of money, or you can be an equity holder, an equity owner. When you own stocks, stocks are a claim on real assets. I'll say that one more time because we're going to talk about that at the end again today. Stocks are a claim on real assets. So you actually own part of the balance sheet, part of the earnings, part of the net income, part of the operating and the equipment and machinery and all the rest of it. When you are a lender, you don't own any of that. And so you are subject basically to the whim of the Federal Reserve. When you look at the bond market today, bonds have produced a negative, and I'm talking just before inflation return, a nominal return of negative 3.38% per year the past 3 years. So not total return, not a total of 3.38, but an annual return of negative 3.38, which is just a disaster. And so when if you went into bonds thinking they'd be a safe place to be, you had a rude awakening, especially for our retired clients, finding out that bonds were not this safety play. They were not a safe hedge against stock market volatility. Even though, yes, yields are up now almost to 5%, you are not getting compensated on longer term debt. If you look at that investment grade bond fund in Honeywell's 401k, today it sits at an effective duration of 6.2 years, which makes 0 sense, in my opinion, to go out and buy a 6-year bond that's paying you 4.8% when we could go out and buy a 1-year bond or even a 30-day bond that's paying 5.5%. And so that's the problem I think you're going to continue to deal with the bond market. The Fed will come out here today with an interest rate hike, I believe, at least a decision. They'll take next month off and go swimming in Jackson Hole and fishing or whatever else they do, and then they'll come back after that and tell us what they're going to do the rest of the year. I think you take way too much risk in bonds for very, very, very little return. And so just be careful. What you want to look at instead, if you have to own bonds, and some of you will have to own bonds simply from the standpoint that you are getting close to retirement. If you are a client at Honeywell, you know one of the things we're doing is when you're about a year out or about 18 months out from officially retiring, we are going to take 2 to 3 years of living expenses and actually put it into this short-term fixed income fund for the reason that we want to make sure we don't have massive, massive volatility right before you retire. So this short-term fixed income fund serves a purpose, and especially as you're, again, maybe 2 years out would be the max, definitely a year and a half out, definitely 1 year out. Again, we can get you close to 5% interest, upwards. It's going to 5.5. That's the next number that you should see the next time we do this presentation. And it's just going to serve as a ballast when we go through stock market volatility. So not bad, but don't overdo it. Don't get overly bearish and put your whole portfolio into short-term fixed income because I think long-term you're going to really get hurt when it comes to inflation. Let's talk about the Fidelity Freedom Funds. Simply what these are target date funds. And target date funds in particular are an absolute disaster. I would encourage you, if you are in target date funds, please get to us, get to somebody, and get out of the target date funds. They are a nightmare. The returns have been terrible. And you can see that 10-year number is substantially less than the S&P. The 5-year number is half of the S&P. It's been a bad place to allocate capital. And one of the reasons why is when you look at your 2035 fund, what that means is that as we approach the year 2035, the Fidelity is essentially taking money out of the stock market and adding to the bond market. And you may not want that. And when you get to the age of 60 or 55 or even 65 and you're getting closer to retirement, you may think, well, Nick, that's great. I heard on Morningstar or I heard on an investment newsletter that I'm supposed to have more bonds when I get to retirement. Well, the reality is that's not always true, because when you're 60 years old or even 65 years old, you still have a long way to go to invest. And if you live till 85 and you live 20 years after you turn 65, you've got 20 years of inflation that you have got to beat. And the problem with target date funds is, yes, they can produce positive nominal returns, positive returns before inflation, but when you factor in inflation, these things barely tread water. So just a warning, be very careful. And this is just, we see a lot of this coming in. It's not just Honeywell, it's a lot of companies out there. So watch out for target dates. A lot of people just get into them because they started at 23 or 25 years old out of school, and they just automatically get enrolled in these things. Don't let your money sit in these places. It's not great. So these are the different options. The returns, again, across the board have been abysmal. Okay, let's go down to this is a good way to understand allocation, and we will customize this for you if you decide to give us a call on a one-on-one basis. But just in general, if you are age 22 to 35, one of the things we want to do is keep you heavy equity exposure because you've got a nice long time horizon before you'll have to use the money, and equities over time do beat every other asset class on earth. But the other thing you could do is take a little more concentration risk. And what I mean by that is you can have a little bit more exposure to Honeywell stock at that point. Honeywell stock has actually done pretty well. And I'm not here to give you advice specifically on buying or selling Honeywell. That's something we'll have to do on a one-on-one basis. But it's not been a bad stock. It's actually done decently well. It gives you good exposure to a wide segment of the stock market. And so I think you can have a little bit of Honeywell stock from 22 to 35. When you get to age 36 to 50, now you're approaching retirement. You're getting a little bit closer to that mid-career point. Keep the equity exposure. Don't panic and get into bonds just because you turn 50 years old. But I would start to reduce that concentration risk. I would maybe get down to no more than 5% in Honeywell stock, maybe 6 or 7. You could be in that range too, but just be careful with your concentration risk because that's the age range I've seen in my experience where if you're overexposed, it can really drag down the portfolio's return. So that's what we do there. And then age 51 to 60. As you get out to retirement, keep your equity exposure. But when you're really at that point where you're saying, okay, I'm going to retire in 2 years, I'm going to retire in 18 months or a year, that's when we start to just build up a little bit in the short-term fixed income fund to make sure that we don't step on a landmine with the stock market and not have the cash available to reach 2 to 3 years of living expenses. So I just had a Honeywell guy yesterday actually who we did this for, and we had been heavy S&P 500, and we took a couple $100,000, about 15% of the overall portfolio, and started putting that into short-term fixed income because the market's already up about 17, 18% this year. So that's one of the things I would think about because he'll be retiring later next year. So that's something to think about. Again, everything should be done on a goals-based approach, not risk-based. And so what I want you to think about, and always keep this in the back of your mind as an investor, is that risk has to be properly defined, not as stock market volatility. It's not the market going up or down. It's not the CNBC ticker tape flying across the screen saying the Dow's down or the Dow's up. That's not valid. That's not risk. That's just volatility. And if you're going to own equities, you're going to have volatility for the rest of your life. Rather, what you want to do is have a goals-based approach that's built on a long-term financial plan. In my opinion, you take 2-3 years. If you're really conservative, 4 years of living expenses, put it aside in short-term fixed income. Now we're getting compensated for that risk management process, and put everything else into equities. That's how you beat inflation over time. So keep that goals-based approach. And the reason why is because over time, I'll go back to my whole statement before, that equities stocks are a claim on real assets. Over the long run, the stock market, and the U.S. stock market in particular, has beaten every asset class on earth. And the reason I know that, now this chart goes back to 1947, but the reason I know that, I'll slide over. I think I got to go this way so you can see it. Stocks for the Long Run, the book behind me, Dr. Jeremy Siegel, who we will have coming to Oak Brook, Illinois, if he can make it, for a lunch for our clients September 7th. He wrote the book on this. He went back not to 1947. He went back 200 years of market history and compared every asset class. He compared stocks and bonds and gold and real estate and silver and palladium and all these different asset classes you could buy. And over the long run, stocks have beaten inflation. Why? Because companies can raise their prices in real time as inflation goes up. So easy example, McDonald's, everybody was worried. They're saying the labor prices are going up, the cost of the wrappers for the Big Macs, the meat is costing more, the tomatoes, the lettuce, the mayonnaise, everything's up 10%. McDonald's doesn't just take it lying down and say, okay, we're going to take 10% less profits. What do? They raised the price of the Big Mac by 10%. And Honeywell is no different. And all these companies, they all do the same thing. They all go to work every single day to keep profit margins in that 10 to 15% range. And when they do that over time, stocks continue to beat inflation. So don't panic, don't get out of the market, stay invested, but be in the right stuff. If you're in the target dates, I would encourage you, get a call on the calendar with us. We will help give you a customized allocation. It's all about customization, not just cookie cutter. And that's what you get a lot of times in these target dates. It's just a set it, forget it, cookie cutter deal. We want to get you on a customized plan and open up that starter account. At least just try it out. We use Charles Schwab as the place that holds the assets for our clients. So we open up an account for you and just start it out. Cost you $10 a year, and then at least with our financial planning software, we start to coach you on that long-term investment plan. We'll link up the Fidelity 401k and start to give you customized advice on that plan. So that's all I've got for you. Thank you for joining us today. If you enjoyed today's content, if you like what you heard, reach out to us. This is the Honeywell Guidebook. Reach out and get a copy of that. Here's our contact information. Give us a call. And if you're local, come see us. If you're getting close to retirement, we make house visits all the time. I'm happy to come and see you and meet one-on-one. So drop a line here in the chat box. We will see that. And other than that, we would love to hear from you. So give us a call, send us a note, check us out online, and we will see you next time for our next Honeywell webinar. Take care.